Okay, for the next part of our presentation, I am so excited for this, for Marcus Hunt and Pat Smith. They are with Title Success, and one of the things that we have started seeing over the last several years is more and more people thinking about getting out of the business and selling their business. And it's so important to know what your business is worth, so that when somebody does come in and make you an offer, you do know what, you are getting a fair market value price for, or if it's just way too low. So I think a lot of people over the last 2 years have decided it's time, So I want to introduce Marcus Hunt and Pat Smith of Title Success. They will be talking on valuations. What's my title company worth?
Good morning. My name's Pat Smith. I'm thank you. I'm I guess Marcus made me the CEO and one of the co-founders of Title Success. We are a couple of old title geeks that have been in the business for a while. I ran a fairly large title agency in Birmingham, Alabama for about 15 years. Before that, I was in claims for a couple of the underwriters, handled some claims as outside counsel. Marcus owns part of a very successful, large and successful title agency in the Southeast. He was my major competitor for a number of years, and we decided, you know what? We've known each other for a long time. We became friends, and a few years ago we became partners. We launched Title Success. So the mission of Title Success is to work with title agency owners and those who would like to be title agency owners to plan succession strategies, to plan exit strategies, or strategies simply to move into the next chapter of your life and your career. We started in 2019. We got smacked in the face with COVID like everybody else. Coming out of COVID, we've been busy working with maybe a couple dozen different title agencies across the country to help their owners achieve those very objectives. So we were thrilled when we had an opportunity to come and talk with you all today about
valuations. And so it's always the big topic, especially in our world, whenever we meet with clients or do events like this, whether it's state association events or ALTA events. And we're always doing succession planning. Pat mentioned that, but kind of the number one question we always get is like, what's my company worth? And so today we want to dig through that with you. We'll kind of talk through, as the slide shows, how do we value companies? There's different models. How do you get down to a number? We're going to talk about what we see in the industry as far as valuations, how valuations go, and what we're seeing kind of as a trend. And then lastly, and probably most importantly, we'll kind of wrap it up with how can you as a title company owner maximize your value in your title company. So, and we'll open it up at the end. If anybody has any questions to ask us, we're wide open, and we'll be here afterwards this afternoon after the presentation to answer any questions or meet with you. So we'll dive on in different ways to value your company. Pat will kind of dive into what are some of the methods and models, and what does that look like.
So when we're talking about valuing or making a valuation of a title company, or any business for that matter, what we really are doing is we are using a number of different models and techniques to try to estimate what the value of that going concern is. And there are a lot of different tools that we use to try to get to that. Now, we live on the coast. I live on the Alabama Gulf Coast. So starting about June of every year, I get really interested in the hurricane forecasting, right? And they show that model on TV of what all the different forecast models of where the storm is going to go. Well, valuing or estimating a value of a title agency is very similar to that. There are a lot of different tools that we use when we start to look at a company to estimate what the value of the company is. A few of them are here. And you have seen some of these before, particularly if you were a finance major in college or you worked in finance industry, accounting major, you've worked in the accounting industry, you've seen these and you have an idea of kind of what they mean. I'm not going to go through them, because there's a YouTube video on a discounted cash flow that goes on for like 2 hours, so you don't want that. But just know that when a client comes to us and says, help me estimate the value of my company, and we start to do some due diligence and get some numbers from them, these are the types of models that we are using to try to come up with an estimate of what that company's value is. Now, I'm using the word estimate of what a company's value is because, think back to our hurricane model again, right? You've seen those hurricane models, and there's all these different spaghetti graphs that shows, here's where we think the thing is going to go. But ultimately, the hurricane decides where it's going to hit. Hurricane Sally was, 30 feet from my house. But, valuing a title company is the same way. I use all of these methods to come up with an estimate. But when it gets right down to it, the value of a title company or any other business is what is somebody willing to pay for it, and is that something that somebody is willing to pay for it, something that you as an owner are willing to accept. Kind of like buying a car. The car dealer has an idea, an estimate of what they feel that car is worth and what they'll take for it. A buyer comes in and they've got their own idea of what the car is worth and what they'll pay for it. And those usually are starting points for discussions and negotiations. I got to go see my sales manager to come down on what somebody is going to sell that car for, what somebody's going to buy that car for. With title agencies, any other business, very similar sort of analysis. So I use all of these different formulas to try to come to an estimate where these estimates begin to coalesce. They tend to start to center around a fairly narrow range of values. And that's where we start our analysis of a company's value. So that sort of gives us an objective number that we kind of work from, but after that, there are a lot of other factors that come into play. Marcos will talk a little bit about what some of those are.
Yeah, so then we get into, again, we got different methods of kind of narrowing down, as Pat was mentioning, to get to kind of a range of numbers, and again, there's different formulas. I want to talk about just some of the things in the market that we're seeing today. We all know it's an active market. Everybody's from either you're exhausted because of the past 2 years and we've been running wide open, and we've got some clients that are just in that boat that are ready to, I need to just step away. I can't manage anymore. I can't handle the stress. I'm not taking any time off. And so people just kind of at the end of the road when it comes to trying to manage and operate their title company. Some of you may be kind of just, I'm at the end of my career. I don't have any family members that want to take over the business, and so I'm ready to get out. And then we've got just another kind of the next generation of title companies, and Scott even mentioned that there's a lot of synergies coming together, and so there's a lot of either companies buying into title. There's a lot of younger title companies that are looking at expanding footprint. So there's an active market, and we see that kind of across the country right now. And so between that's a trend. We talked about the aging demographic of owners. And so, again, the title company, there is kind of an older generation of ownership right now. And so there's that trending. Enhanced technology, as Scott mentioned, that's some of the factors, again, as I said a minute ago, that's kind of changing the way title companies' ownership looks, whether that's merging with real estate brands or mortgage brands. We see that across, and some of that's coming together through technology. And then, you and I know one of our biggest pieces is talent, trying to find talent. And there's a lot of acquisitions going on that I call that really just talent acquisitions through an acquisition of a title company. People need talented staff and talented people, and sometimes that happens through an acquisition as well. And again, you'll hear Pat and I reiterate this multiple times today. Just again, the value of what a title company is worth is really made up of what someone's willing to pay and what someone, an owner's willing to sell for, and kind of what all the things that happen to meet in the middle.
So I want to follow up on a couple of things Marcus mentioned about where people are in the process of thinking about, considering, toying with the idea of maybe it's a good time to sell my company. And we'll talk a little bit about some real life examples of the people we've worked with anonymity. We're working with a title company owner right now, and I mentioned this to Missy. She's just tired. She's just worn out. The demands of the business over the past several years, her individual driven personality, some family issues with her husband had an on-the-job injury. Her key employee, one of her key employees, is ready to retire. It's just a whole group of events have come together to the point she's just, I've got to get out. And I suspect that a lot of you in the room, and a lot of you that may hear this down the road, can really relate to that. You're tired. And we get that. You're at a good time to be tired, because there is this new generation, or this new group of title agency owners, entrepreneurs, I call them, title entrepreneurs, that are looking to grow and expand and cover large geographic territories through acquisition of agencies and acquisition of talent. So it's a good time for that. So how do we go about assessing a company? How do we, how do we take those initial steps? Well, when we're doing evaluation, we look at, we mentioned a lot of the different objective valuations. Within the objective valuations, we still have to make some assumptions, and we spend a lot of time talking to our clients, both on the buy side and the sell side, to get a grip on what those assumptions might be. For example, I want to know, if I'm going to be evaluating a company, are they going to be able to continue the revenue model that they've had the past 3, 4, 5 years. What does the market look like in your particular geographic location? You've heard it said, all real estate is local. And back during the 06, 07, 08 time frame, where markets were rapidly crashing in some parts of the country, in some of our local markets in Alabama, they barely saw a blip because of things that were going on locally in that market. So if you're talking to me about a title agency in Stillwater, Oklahoma, I'm going to want to talk to you about Stillwater, Oklahoma. What can you tell me about Stillwater, Oklahoma? For one thing, it's like Auburn, Alabama. There's a college there, a large one. That typically adds stability to a particular environment because there's a pretty steady turnover of people coming and going. If you ask me about a market in East Alabama right now, around Auburn, I'm going to see that as a very strong market because we're digging a lot of automotive parts manufacturers that are moving into that area to support all of the automotive factories that have been built in the tri-state area of Tennessee, Georgia, and Alabama. So, I want to talk to you about how do things look here? What's the market like? What are you expecting? I want to look at the Federal Reserve's local Federal Reserve District estimate for the economic outlook for the area. I want to talk to the local Association of Realtors about what is their estimate of what the housing market is going to look like. What are my construction starts, building permits? So a lot of these things go into the valuation. We're not just looking at your financial statements and saying, yep, 3.5 times earnings before taxes, insurance, depreciation. We want to see where that's going to go. We do definitely want to see your financial statements. Now, I want to see, and the buyer's going to want to see, financial statements that clearly represent the business operations of the company. Tax returns are one thing, but financial statements are a little bit different. And we're going to talk here about the necessity of putting together a team of trusted advisors to help you position your agency in the marketplace. One of the cornerstone of that team of advisors is a CPA or an accountant who can help you take your Quicken or QuickBooks file and put together a set of well-organized, well-designed financial statements that accurately reflect the operational results of your company. We have a client whose dues and subscriptions line of their P&L includes their subscription Porsche rentals. That's a subscription service. They get a new one every 3 months. It's like a subscription. They come in every 3 months.
I didn't even know there was a thing.
We didn't even know it was a thing. Their client entertainment line includes, season tickets to the local Major League Baseball team. So now these are things that probably are not going to stay with that buyer when they come into the company. So when I get your financial statements, I want to sit down and talk to you and say, okay, now, if you leave or if I buy this company or somebody buys this company, what on here goes with you?
And Pat, there's, we talk about, because one of the first things we do whenever we start the valuation process is ask for, your QuickBooks or your P&Ls and just try to get a breakdown of all the numbers. And a lot of sellers are like hesitant because, we're paying for this. And here's the thing. Here's a little secret in the room. Everybody's got something that we, either pay for out of the company or there's a benefit over here. So it's all there. As a team that's helping put together a valuation, we just want to get to the right number and the number that either adds value back at the end of the day to your company. So those, MLB tickets or the NBA tickets that are on the books for the company may or may not stay there. But if they're not, we can roll that back in, or the membership or the car loans or all those kind of things may. Sorry, I think I clicked forward. Those things may get put back into the company and again be other revenues that actually stay within the company. And so our goal is to drill down and get to the bottom line number. And again, so don't let that be a fear if you're kind of in the stage of looking to try to do evaluation. Be up front with your team to get those numbers and clear, so we can get a clear set of books.
And it's not just, Marcus mentioned this, it's not just expenses that maybe are going through your company that might better go through your personal checkbook. I'm not worried about that. We've also worked with clients who had revenues that were accruing to them as an owner that didn't necessarily come through
right.
the financial statements, but would be available to a purchaser.
Yeah.
And we had one circumstance where that actually added $500,000 of valuation to the company.
So maybe like management fees for, say, maybe a joint venture or something that you have that really they were going to that individual owner individually instead of rolling into the company. But an acquiring company would roll those probably all back into the main company.
Yeah. So we like to get down to a real good, clean, accurate reflection of your financial statements. And to do that, I'm either going to spend a lot of time on the phone with you, or I'm going to say, you know what, I'm going to come see you. And I'm going to come, we'll sit down in your office and just talk through it. It's I'm an attorney, I'm not your attorney, but hey, just, kind of like your priest, you just kind of confess, tell me all your sins, right? We'll get through it. We'll forgive you. The other thing I want to do is I want to talk to you about your company. I want to talk to you about how it runs, who does what, who are your key employees, what's your relationship with them, how long have they been here, what's your turnover, the people that have left, why did they leave? They leave for more money, they leave for a better opportunity, what's going on? I want to get a sense for how well that company runs from Monday morning to Friday afternoon. How involved are you as the owner in what goes on here every day? That's another thing that I have to try to separate. If you are actively involved in your company, if you're coming in every morning and you're going to the plant and you're doing searches, or if you are reviewing settlement statements and are sitting at the closing table, I've got to look at the financial result for the company for the year and break out how much is what you're doing on that daily basis worth as an employee versus what is your return on your ownership position in the company. We have to kind of get a grasp for that so we know how to position that to a potential purchaser. I want to know who your clients are. Or, do you have a lot of lender clients? You're doing a lot of refinances. Is your business sensitive, interest rate sensitive because of the refinance market? Are you representing a lot of builders in a market where it's very quick growing? We represent a company that's on the outskirts of a very large metropolitan area where there's the building boom is going to go on for years. What's that client mix? Who's your biggest client? And what percentage of your business is that biggest client? If you've got a client that's 40% or so of your revenue, we want to know that you've managed to lock that client in through some sort of joint venture arrangement or some sort of deal where if they decide to go next door, that sucks a lot of value out of the company. So we want to know who these people are.
Yeah, and all these go to just kind of as we kind of move down the path of evaluation. So we drill down and see numbers. We try to get to a number, but then we look at multiples, and so the multiples of are kind of what is the key factor of okay, what am I really going to get at the end of the day for my company? And all these factors that Pat and I are talking about right now really go to like increasing or decreasing or how that sliding scale of the multiple works. And so that could be, we've seen everything from 3 times multiple to 6, 7 times multiple, and I've heard of a few more, but I don't even.
We think they're lying.
Yeah. But kind of the multiple sliding, scale is based on these factors that we're talking about. What's going to happen to ownership? What is the real true profitability? What is the client mix? What does that look like? What's the market that you're in? And all those things make up the important pieces of the puzzle that determine what this multiple is. One other piece that's here, the last one, key employees. Again, I always talk about this is a people-driven business. It's people. And our key employees, if you have 2 or 3 key employees walk out the door after a transaction occurs and you've sold your company, that's going to affect a lot of things, whether there's some of the ongoing payments to you are based on the profitability of the company after the sale. If you got 2 or 3 main salespeople or people that are tied to business that walk out, that could severely affect the revenue that's being generated. So we always look at key employees as a big factor when we're trying to find out multiples and
how can we
price.
assure that those people are going to be around? Some states, many states, our state, Alabama, frowns on covenants not to compete. But they don't frown on golden handcuffs, so that we can try to create an environment where those people are incentivized, not just today, but down the road for sticking around. So that that person who buys the company and comes in knows that those key employees, they have the opportunity to continue to benefit from those relationships going forward. So, I think you maybe can start to see that valuing or coming up with an estimate of the value of a company is not as simple as looking at your financial statements, making additions and subtractions to get down to your true cash flow and applying a multiplication table to it. There are a lot of factors that go into it, which is why you need this team of trusted advisors that we'll talk about as we move forward a little bit. So I mentioned assessing your company. EBITDA. How many have ever heard this thing called EBITDA? That's not a musical about a South American dictator. That was Evita. EBITDA, earnings before insurance, taxes, and depreciation. If you are keeping your books on an accrual method, nobody does. But if you are, I want to get to a cash basis. I want to know the amount of free cash flow that your company generates during the year that can be used toward the operations of the business or compensating the owners. We talked about objective variables. That's your EBITDA. Those are your discounted cash flow. That's your net present value of discounted future cash flows. It's your opportunity cost for considering what the price, the cost of the investment is. If I've got somebody that's got money to come and buy your title company, and they've got $10 million sitting in the bank, they're making money on that $10 million somewhere, somehow. It's invested. Well, it doesn't do them any good to buy your title company if they don't think they can make at least that much money running your title company. So, we're looking at what's the cost of capital for potential acquirers. Geographic location, we talked about that. Florida right now, in more ways than one, is a hot market. Everybody wants to be in Florida. Well, $6 a thousand rate, has something to do with it. But a lot of people are moving to Florida. Pennsylvania, maybe not so much right now. But different geographic location has some impact on your valuation. Your individual, we mentioned this, your individual share of the market. Do you have 40% of the local market? If so, that gives you a little bit better subjective valuation than somebody that's got 2.5% of the local market. You both still have value, but somebody who's looking to move into that might rather acquire a 40% market share than a 5% market share and have to grow it. Again, doesn't mean your company's not worth good money if you're at 5%. It just means that your neighbor down the street may be able to get a little higher multiple.
And that may be even, you may be looking at someone that's not even coming in from out of town. It may be you may be a title company that's looking to acquire, and maybe you want to pick up more market share, or again, as we've talked about, pick up talent. That's again always a big factor when it comes to acquisitions. But again, all these things are driving valuation when it comes to what the total number is. There's not. I wish we could come up and say, give you a specific number and say this is what your title company's worth. But again, there's so many factors that come into play when it comes to pegging that actual number. And again, as we said when we started, so much of it depends on what a buyer's willing to sell for, to buy for, and what a seller's willing to sell their company for, and where that meets in the middle.
Yep. So what the goal of any one of these exercises for you as an agency owner is achieving the best sales price for your company that you possibly can.
And I think this is where we really want to land now. Like, what are some of the things as an owner right now that you can be doing to maximize the value of your title company? And again, a lot of these things are kind of go through the same items that we've touched on so far, but again, just how can you put them into play when it comes to your company? And so as we kind of dive in, we'll talk about people. And we've got several things when we talk about people. Number one, the role of the current owner. So if you're an owner that it's just up to here in work every day and you're drowning because you wear so many different hats, and I've been there. I've run a small title company that's got 5 people in the building, and I've run a company that's got 70 to 100 staff members. So if you're in one of those small title companies, and that happens a lot in small towns especially, you're wearing a lot of hats, and so you are really up to here when it comes to all the things you've got to do. But when it comes to exiting and creating an exit strategy, you've got to be able to replace what you're doing with someone else. And so we encourage owners to start figuring out either key staff people that you can put into certain roles to start taking over certain pieces. So maybe as you step back, you've got people in place to be able to go ahead and start running and carrying the torch on your company's behalf. Because we look at as an owner, a couple other things. Do you have some people have family members or key staff people that are able to step in, and some owners, there's not someone that's ready to kind of assume that role. So either you've got to go develop it, or you've got to figure out a way to kind of back yourself out of it. Because Pat and I have worked with several clients that have kind of been in the spot of the owner did all the work, and so there wasn't someone waiting there, and really all the profits for the company kind of were the owner's salary. And we talk about, if I've got to pay $100,000 for a manager of a title company and you're only making a little bit more than that, okay, so then what's the company really worth? And we've seen that play out in several circumstances.
And two of the clients we've worked with that have achieved, I think, some of the better valuations. One was where the owner made a decision several years ago that she wanted to retire by a certain time. She picked a key employee of the company and began to mentor and train that employee to where when her transaction closed, she had pretty much stepped away from that day-to-day management of operations of her company. She worked on big pictures, she worked on creating value, maximizing value, growth strategies, worked on the business, but not so much in the business. And when we came time to do that valuation, taking that into account, that played a key factor not only in what we estimated the value of the company would be, but also in what the ultimate purchaser was willing to give for that company. We've seen others where the seller wants to stay in the business. They want to stay there. I just don't want to run this anymore.
Yeah.
Okay, fine. We still have to have somebody who can take over that and handle the Rhino reconciliation exceptions every day. They can make sure the policy report gets out at the end of the month, and that the money goes to a steward or First American or whomever. So if you're in that position, and a lot of us are, that's something to start thinking about is homework.
Well, and then another thing that we do kind of out of the gate when we sit down with a client, one of our big questions, what do you want as an owner? What do you want to do? What does the next 5 years look like for you? Are you I want to work another 5 years? If I sell, I'm hopping on the boat and I'm, or headed to the beach or retiring with the grandkids and I don't want to step back in the office. So there's that big question of what do you want to do as an owner? There's a lot of the companies that we work with and that are acquiring really want that owner to stick around for a minute, just because there's so much value there to that owner being a part.
There's a book, and I'll recommend this book to all of y'all. It's called Built to Sell. It's by an author named John Warrilow, W-A-R-R-I-L-O-W. It's available off Amazon or anywhere. And it talks about this business owner who thought he had a fabulous business. He had all these great clients. He went out and got the clients. He helped them design their ad work and all this kind of stuff. And he wanted to sell the company, and he went to a guy, and the guy said, your company's not worth anything. That's what he means. So you are the company. Everything, the only way you're going to get anything out of the company is if you stick around and stay here for 5 years, and you get paid out over 5 years, and during that time, the purchaser transitions the company. Well, I want to go to the beach now. Okay, then you need to do your homework. Just kind of what we're talking about here.
So that's the role of the owner. Again, what do you want to do as an owner, and then again, how to transition out of that role. Other key factors when we're talking about people. Again, we mentioned earlier key employees. How do you make sure you retain key employees? Make sure they're on board when you're looking to make a transition. And so Pat mentioned kind of golden pair. How do we create incentives for retaining key employees? And that may be some kind of incentive for staying on, for a period of time after a transition, maybe giving some kind of, bonus or some kind of structure for, incentive pay to retain key staff members. And so we do that. And then other client mix, talked about, are you heavy in one area or another? Maybe you shouldn't be tied to only one customer, because again, that's a big factor. So maybe some of the things you can do to help better your value is to diversify a little. Maybe you don't have any builders, so maybe you focus on getting some builders. Maybe you're completely wrapped up in a lot of lender work, and so maybe you go to try to develop some other realtor work. And so all those things, again, having a better balance helps kind of have a better chance at increasing your value, and that increases the multiples of that you can get when you're looking at selling.
We got operations.
So
now?
Operations, Pat?
Yeah, we'll talk about operations. So can we all agree on a fundamental truth that a well-managed company is better than a not so well-managed company? And some of us have been in both of those kind of companies, right? And think about that. The ones that are well-managed with good management, good leadership, well-trained employees who are confident in their ability to make decisions. They are allowed to make decisions. They are allowed to exercise judgment. They feel confident in what they do. So that's the type of company that we love to see. The ones where we come in and people are a little bit scared because they're going to get yelled at if they cost the company $10 on a recording fee. I get a little nervous about those because I want these employees to feel confident. I want the leadership to know that they have done a good job at being leaders and empowering and training their employees. When I come in, I'm likely to say, hey, if you got documented processes and workflows for your intake and title searches and all this kind of stuff, well, no. Betty does that, and then she sends it over to the plant, and Rob in the plant does the search. I said, have you ever written this all down? If Betty gets run over by a truck on the way in today, can somebody come in and sit in Betty's seat? And have they been trained to do that? Or do they at least have a manual, a process, an operations manual that they can study and get an idea of what they're supposed to do? I can't tell you what percentage, but it's a high percentage where this is not something that people have invested time to do. And it is one of the biggest return on your investment of time that I think you can ever make, because it's not only valuable to somebody who's coming in who wants to look at your processes and procedures as a value to the company, it's valuable to your company today. So if you haven't done that, that's some of the best homework you can do. Hey, Betty, today, while you work what you do, write down everything you do. Every website you do, just write it down. Let us start putting that together. Betty's going to think, oh my God, I'm about to get fired. No, you're not. You're not. You're good at what you do, and I want to know what you do so that if you get run over by a truck or you hit the lottery and decide you're peace out, I want to be able to put somebody here who can do that.
And that just goes to, again, to how you can remove yourself, or even if there's key employees or someone steps away, or maybe, all these factors that, again, let the company keep running successfully without, if someone steps away, or as an owner, once you sell and you step away.
One of the most valuable things that I did when I managed a title insurance agency was I had a consultant come in that had formerly been with one of our software vendors and document our workflows. She stayed in our office and met with our closers and our processors and our title production people and talked to them about, what do you do? And then she documented all of that, and then she came down and sat with me and said, okay, here's what your people are doing. I said, well, that's about right. She goes, this isn't real efficient. You're getting the job done, you're getting product out the door, but you're taking more time to do it than you probably could. Okay, talk to me. Well, if instead of Betty doing this, if Rob does this over here, and if Rob prepares the commitment instead of sending it back over here to a typist, you could save, well, goodness gracious, in about 3 months, we have become much more efficient because we improved the efficiency of our workflow.
Another thing, that would like to, kind of take a peek at is technology. What does your technology look like? There's a lot of companies out that have moved into a little more, scan docs and everything's in the cloud. So there's a lot of, protection there as far as not losing documents or be able to access them. But an acquiring company is going to want to know, is there a room down the hall that's got a bunch of, hard paper files and boxes that are just, actually I went into a title company a month or so ago, and they had still a big, huge storage room of nothing but boxes of files. And you may be one of those companies. I would encourage you to, as quickly as you can, again, to start looking towards technology to make things more efficient, because most of the companies that are acquiring, that is one of the pieces that overnight they're going to want to switch. If there's a successful company that's in acquisition mode, they are heavily invested in technology, and so they're going to overnight come and want to kind of flip the switch with technology. So the more you can do now, if you're not there, the better you'll be when a transition happens.
And the final piece of that, and we can thank our friends at Alta for helping us with this several years ago with the adoption of the best practices format, as well as our underwriters for their audit programs, is what's your compliance look like? We are, whether we like it or not, a highly regulated industry. We've got RESPA to think about. We've got Federal Trade Commission to think about. We've got our local state title requirements to think about. How are we doing on compliance? One of the things that I like to see if I'm looking at a company is, hey, have you got your not only your certification for your best practices, but you have the materials you provided to your certifier, your examiner, that we can go through and see how mature your model is. How well are you checking those boxes, and how consistently are you observing those processes that are set out in our best practices. You got joint ventures? That's great. Let's talk about those. Do you have marketing services agreements, MSAs? That's great. Let's talk about those. Who did your MSA work? Can I see your joint venture? I want to talk about this. Because if somebody's coming in and they're looking at making maybe a stock acquisition or an equity acquisition, these are things that they're going to take on, or they're going to want you to indemnify them for. So the more work we do up front to assure ourselves and to assure a potential buyer that we're doing the right things the right way all the time, then the better we are. And if we find out or we suspect that maybe we're not doing the right thing the right way all the time, that's okay. Let's fix that.
Yeah.
Let's make that better, so that by the time somebody comes in and we have this conversation, we've addressed those things and we can provide documentation as part of the due diligence process that we're doing the right things the right way all the time.
And just to wrap up, I know we're running out of time, so kind of as we wrap up
We never run out of time.
this section, just the financial condition. We've kind of talked about finances and some of the things that we want good financials. So if there's some cleaning up that you need to do, do them now. Get your books in order. Understand kind of those are going to be some of the first questions that come across. So if you're number one doing evaluation, obviously that's first thing out of the gate. But two, whenever you're looking at an acquisition or selling your company, those are just the things that are kind of the top of the list whenever an acquiring company comes looking. So we've talked about ways to do that, and again, surrounding yourself with a great team. A financial team, CPA, that can help you kind of walk through those steps. And just wrapping up, it's kind of one of the things that Pat and I kind of always end as we summarize kind of this presentation and talking about valuations. Number one, it's never too late. I know you always hear it, start now. Like there is, when you get back in your offices after this event, start now. Start chipping away. Figure out, get a game plan together. Whether your timeline is 10 years down the road or whether it's, 6 months down the road, it's time to start. Whether it's finances, whether it's trying to figure out key people and maybe figuring out some ways as an owner to kind of step away. Start looking now for ways to do that. And there's plenty of resources. Again, whether you have a consultant and like what our team does, whether you have your CPA or an attorney, surround yourself, build a team to start figuring out ways to put your company in its best light and have a product that an acquiring company really wants to, that's super attractive for someone to acquire.
Who all in the room worked with an underwriter? If you work for an underwriter, raise your hand. All of you who don't work for an underwriter, you're an agent, that's where your team starts, right there. Your underwriter is your best friend during this process.
Yeah.
They have resources, they have skills, they have connections. Believe it or not, they are concerned about you. They want the best for their agents. I've never seen an underwriter representative that did not want the best for their agents. So that's a great place to start when you're talking about building a team. A CPA, a good insurance person, because if you're going to be into succession planning, which is part of this process, and you've got partners, you need key man life insurance, you need to make sure that those types of agreements are in place. A good business attorney, not necessarily your buddy that you play golf with on the weekends, but somebody who is skilled in business transactions, who can help with those agreements and make sure that your behind is covered as best it can be. Start putting these people together. There's a lot of people talk about having a personal board of directors, right? This is somebody that are your trusted advisors and your consultants, that if you're in a bind and you need advice, this is who you go to. Start putting together that board of trusted advisors and consultants that you can go to help you through this process. And let them know, hey, you're my go-to guy, you're my go-to gal. I'm going to be calling on you. They'll be excited because they want the best for you too.
And then again, just lastly, just have that plan in place. And It can be a loose plan of how I want the next 5 or 10 years to look like, or it can be a very detailed plan. If you've got a short window, you need to start working through a pretty strong checklist of what needs to happen. So do that, and that kind of wraps up. We're open for questions if there are any. And so we'll open the floor. We'll also be in kind of out. We've got a little table, so feel free to stop by there. We've got, I don't know if any of you got it, but in the title report, they did a special mergers and acquisition kind of special report. We've got a couple copies of that if anybody wants one and just some additional info. But I'd like to just open the floor. If you got questions about valuations, it's available for you right now. Questions?
And we'll be out here. If you've got a question maybe you don't want to ask, like, is it okay that I'm deducting my doggy daycare, from the company? Well, maybe, I don't know. Come see us. Let's talk about that. But the main thing we want to do is just let you know that we are a resource. There's some other people in this area that do kind of what we do, but we are a resource. We have worked with your colleagues. We've worked with your underwriters. We feel that we can provide value to you and your company as you start to embrace this process, take this next step in your next chapter in your career and in your life. Last thing we want to do, we want to thank you, Mitzi, Oklahoma Lantau Association, for inviting us to come and be a part of your conference and giving us the time to talk. You can tell, we like to talk. And so when anybody gives us an opportunity to come and talk to a great organization like this, we try to find a way to be here, and we're so thankful that we were able to come, and we're so thankful for the invitation. Thank you.
Thank you.
I just really felt that, it would be good because I don't think you need to know this information if you're thinking about selling. I think you need to know this information just for your daily work, because you do not know, like he said, when you get hit by a bus, you don't plan that. But if you know ahead of time and you're prepared ahead of time, if you do get hit by a bus and your family don't want to buy that business, they don't want no part of it, you've done your due diligence. And so when somebody comes in to make an offer, okay, mom and pops, they're getting the money it was really worth. Because all of our companies mean a lot to us. And I think I'd love to see this show go out on regional meetings, because we have so many people in the rural areas that don't and are not able to come to our OLTA meeting because they can't be out of the office. There's not enough employees. But yet they need to know how much that value that they put all their heart and soul into every day is worth. So